The broadcast is now starting. All attendees are in listen-only mode.
Why did it come to Germany?
Good afternoon and a warm welcome to all. I'm Radul, and on behalf of Care Ratings, welcome you to our today's webinar on Indian economy prognosis for 2019-20. Appreciate your time in joining us for this webinar. To take you further on this, may I introduce our speakers for today. We have with us Ms. Kavita Chacko, Senior Economist at Care Ratings. Along with her is Sushant Hede, Associate Economist. The discussion is in form of a presentation which is visible on your screen. In case of queries, please key in the questions in the slot provided. Our speakers will take the Q&A session at the end of the presentation. May I request Kavita to begin the session?
Thank you, Radul. A very good afternoon to all. We thank you for joining us for this webinar today. In this webinar, we are presenting our outlook for the Indian economy for the current fiscal year. Herein, we provide our projections for the performance of key macroeconomic indicators based on the prevailing and evolving domestic and global conditions. The passing of the election uncertainties and the impressive win of the current leadership bodes well for the country's economy, which has witnessed 2 successive years of subdued growth. The stronger mandate for the second successive 5-year term of the current government mainly ensures continuity in policy and reforms framework. The political uncertainty, which was coming in the way of investment decisions and impeding foreign investment inflows, has ceased, and expectations of a revival in the domestic economy has increased. At the same time, internal and external challenges and risks that can stymie the domestic economic revival abound. Global trade uncertainties and political tensions show few signs of abating in the near future, and rising crude oil prices, slowdown in global economic momentum remain concerns. Additionally, lower than expected normal monsoons, muted domestic consumption and investments, so slow growth in job creation and liquidity pressures in the domestic NBFC segment could come in the way of overall growth in the economic activity. Given the prevailing economic conditions, challenges, and emerging risks, a sudden and significant spurt in economic activity and investment is unlikely in the current fiscal year. There would be gradual improvement over the next 3 to 4 quarters, which could set the tempo for stronger growth in future. Our forecast for the performance of key macroeconomic indicators has been summarized in this slide here. To note here is that we expect overall domestic economic growth to be higher in 2019-20 over a year ago. Also, investments, industrial output, bank credit and deposit growth, foreign inflows, which includes both foreign portfolio inflows and foreign direct investments, are expected to see an improvement over last year. We also forecast higher corporate bond issuances and a build-up in the country's forex reserves during the current fiscal year. At the same time, we foresee inflation to inch up and the rupee to depreciate during the year. Besides, exports are to see a moderation in growth while imports rise, which would lead to a widening in the current account deficit. We now have a closer look at each of the economic variables wherein the current situation is highlighted along with the basis of our future outlook. Coming to overall economic or GDP growth. The domestic economic output was subdued in 2018-19 with GDP growth for the year as estimated by the Central Statistical Office to be at a 5-year low of 7%. The growth slowdown was mainly on account of the weakness in consumption demand and continued subdued private investment activity. Private consumption, which has been the mainstay of the Indian economy, has been impacted by the prolonged periods of low income growth, coupled with the liquidity issues in the aftermath of the NBFC crisis from the second quarter of 2018-19, which constrained availability of funds for producers as well as consumers. Economic growth during the year was supported partly by exports and higher government spending towards infrastructure building. The prevailing economic weakness, as witnessed partly in the lower consumption demand and industrial output, makes boosting economic growth the foremost priority of the new government. Although recent measures such as income support scheme for farmers could to an extent support demand, direct intervention by the government in certain areas such as agriculture, employment generation, tax reforms, address banking sector issues, and continued capital expenditure is warranted to stimulate economic growth. Although we expect higher economic activity during the ongoing fiscal year on concerted efforts by the government and policy makers, with the prevailing challenges such as lower consumption and investment, it is unlikely there would be immediate reversal in economic conditions. The improvement would be gradual and limited. We project the country's GDP to grow by 7.2% in 2019-20, which is 0.2% higher than a year ago. Coming to investments. Investment, which is essential for propelling growth, continues to be subdued. The investment rate measured by the gross fixed capital formation is estimated to have improved marginally in the last fiscal year. As per the second advanced estimate, the investment rate in 2018-19 at 28.9% of GDP is at a 4-year high. It nevertheless continues to be significantly lower than 34.3% in 2011-12. The progress in investments is also seconded by the rise in the capacity utilization rate of businesses, which is based upon the RBI's capital utilization survey, which has risen from 73.1% in 2017-18 to nearly 76% in the third quarter of 2018-19. A rise in capital utilization prompts fresh investments. Investments have been tended to be sustained by higher government public spending. Private investment continues to be restrained primarily on account of lower demand and financial constraints. Political uncertainty has also been a factor that limited private investment during the last 2 months. We expect the investments in the domestic economy to improve slightly in 2019-20, with investment rate for the year projected to be 29% of GDP, which is 0.1% higher than a year ago. Investments would continue to be driven by government spending on infrastructure. Despite the ceasing of political uncertainty, private investment would pick up with a lag. Public investment and government policies would be essential to stimulate private investment in the future. Fiscal consolidation is essential for sustained economic growth, and the government has a roadmap for the same. The government's fiscal position was pressured in 2018-19, which led to a deviation, albeit marginal, from the path of fiscal consolidation. The fiscal deficit target was revised upward from 3.3% to 3.4% of GDP, primarily due to lower than anticipated tax collections, namely GST collections, and higher non-discretionary expenditure of the government. The government in its interim budget for 2019-20 has set its fiscal deficit target at 3.4% for the year. There is a rising need to boost demand and spur economic growth led by the government. This necessitates a certain level of flexibility in fiscal policy while not deviating too much from the path of fiscal consolidation. The current budget target provides limited space to stimulate the economy due to higher expenditure towards welfare schemes. Also, there is the risk that tax revenue collections could be lower than expected if consumption demand does not increase. At the same time, an upward revision in fiscal deficit would also result in higher market borrowings by the government, which could push GSEC yields and consequently interest rates higher. The fiscal deficit target could be revised upwards by not more than 10 basis points to 3.5% of GDP for 2019-20. In terms of the performance of agriculture, the sector witnessed a decline in growth to a three-year low in 2018-19. At 2.8%, the growth was 2.2% lower than a year ago. The lower growth can be attributed to uneven and below average monsoons during the year. There are contrasting forecasts for the 2019 monsoons. The Indian Meteorological Department has predicted a near normal monsoon of 96% of long-term average, while SkyMet, which is a private weather forecaster, has forecasted a below normal monsoon at 93% of long period average. Given the vagaries of monsoons in terms of distribution and quantum, and the lack of irrigation infrastructure across regions, agricultural output could be impacted. We expect output for the sector to grow at a stable rate of 2.8% during 2019-20. In 2018-19, industrial output grew at the lowest pace in 3 years. The slowdown in industrial output can be attributed to the moderation in manufacturing growth, which grew at 3.5% versus the 4.7% growth of the previous year. Lower growth was witnessed in the output of primary goods, capital goods, intermediate goods, and consumer non-durables alike. Industrial output in the current fiscal year is expected to be higher and is likely to be driven by higher government spending in infrastructure. We expect industrial output to grow by 4.5 to 5% in 2019-20. The favorable statistical base effect would also be a factor for this higher growth. I now request Sushant to take forward this webinar.
Thank you. Moving on to inflation, we expect both retail and wholesale inflation to remain at tolerable levels in 2019-20. During 2018-19, CPI fell to a 7-year low of 3.4%, chiefly owing to decline in food inflation. Food inflation witnessed a contraction for 5 successive months, that is from October 18 to February 19, dragging overall CPI lower. However, the fall in CPI was limited with core inflation, that is excluding food and fuel components, remaining high, averaging 5.8% during 2018-19 compared with 4.7% a year ago. On the other hand, WPI firmed up to a 5-year high of 4.3% in FY19 as against 2.9% in the previous year, driven by higher fuel prices. Both CPI and WPI remained around RBI's target inflation level of 4% plus minus 2%. Price pressures have been emerging with the rise in food and fuel prices. At the same time, core inflation has been moving downwards, reflective of the demand scenario. We expect consumer price inflation to average 4%, while wholesale price inflation to average 4.5% during the current fiscal. We expect higher retail inflation during the year, with upside risks emanating from the pattern of monsoons, movement in crude oil prices, and price pressures from the food component. Despite the upside risk, we expect inflation to remain in the target range set by the RBI, which in turn would guide RBI's monetary policy. RBI is likely to pursue an accommodative monetary policy in the current year. During 2018-19, the RBI raised policy rates by 50 bips during the first half of the financial year to 6.5%. This was on account of inflationary concerns following the increase in the global crude oil prices and concerns over the impact of US Fed monetary policy tightening. In the second half of the financial year, the RBI reduced policy rates by 25 bips to 6.25%, with inflation moderating and the economy showing signs of weakness. We believe that the economic growth concerns and the tolerable levels of inflation would be key considerations for the RBI to pursue an accommodative monetary policy in 2019-20. With the central bank reducing policy rates by 25 bips to 6% in the first bi-monthly MPC meeting of 2019-20, we expect RBI to further reduce policy rates by 25 to 50 bips and be in the range of 5.5 to 5.75% in the remainder of the ongoing fiscal. We expect the prevailing trend in bank credit and deposit growth, that is, bank credit growth surpassing deposit growth, to hold in 2019-20. During 2018-19, bank credit grew at 5-year high at 13.2%, higher than the 10.2% growth of the previous year. The growth in bank deposits was 10% during 2018-19, which is 3.8% higher than a year ago. The growth in bank credit was driven by double-digit growth in services and retail loans. Bank credit and services grew by a substantial 17.8% over the 13.8% growth in the previous year, mainly driven by higher credit disbursements to NBFCs, shipping, wholesale trade, and transport operators. Retail sector continued to witness double-digit growth in bank credit at 16.4% over higher growth of 17.8% in the previous year. The credit to industry also saw a growth of 7% as against 0.7% a year ago. We expect bank deposit growth in the current year to benefit partly from the present NBFC challenges, where debt funds have been impacted and households are likely to move back to bank deposits. However, we believe that lower term deposit rates could make deposits less attractive for savers. We expect bank credit to grow by 12 to 13%, higher than the bank deposit growth of 10 to 12% during the current year. Moving on to the debt market. During 2018-19, the total corporate bond issuances aggregated rupees 6.5 lakh crores, which is 8% higher than the issuances of rupees 6 lakh crores in 2017-18. In the first half of 2018-19, corporate bond issuances were 30% lower than the corresponding period previous year. However, higher issuances witnessed towards the end of the fiscal, that is, in March 19, helped offset the lower issuances earlier in the fiscal. We expect corporate bond issuances to be higher in the range of rupees 6.75 to 7 lakh crores in 2019-20. We believe the regulatory changes from SEBI and RBI for large borrowers could propel the corporate bond market. However, the positive impetus on account of this regulatory change would be limited as most of these borrowers are already in the bond market. At the same time, with limited pickup in private investments, there will not be a significant jump in the corporate bond market issuances in the current year. We will now cover the external sector indicators. First, foreign inflows could see resurgence in 2019-20, especially from the foreign portfolio investors. During 2018-19, foreign direct investment stood at $44.4 billion and was 1% lower than a year ago. The election led uncertainty on the domestic front and global headwinds such as slowdown in global economy, trade war uncertainties, concerns over Brexit negotiations, and other geopolitical tensions led to lower FDIs. On the other hand, foreign portfolio investors were net sellers during 2018-19 as opposed to being net buyers in the previous year. The first 7 months of the fiscal saw heavy selling by the foreign investors owing to depreciation in the rupee, widening current account deficit, tight global liquidity, and monetary policy tightening of major central banks. Thereafter, there has been a reversal in the trend with more foreign portfolio inflows, chiefly on account of a stronger rupee and the shift in the monetary policy stance of advanced economies to an easy monetary policy. We expect foreign direct investment during 2019-20 to be in the vicinity of $45 to $50 billion and foreign portfolio investment to be around $25 billion. The improved sentiments post-elections, low interest rate regimes in advanced economies, and economic prospects the country holds when compared with other economies would result in higher foreign inflows into the domestic economy and markets. In addition, changes on the regulatory front like introduction of voluntary retention route by RBI in March 19 and allowing FPIs to have corporate bond exposure of more than 20% in a single corporate have been aiding foreign portfolio inflows in recent months. We expect India's trade performance to be subdued in 2019-20 on the back of import growth outpacing export growth. During 2018-19, trade deficit widened, albeit at a slower pace compared with the previous year. This was chiefly on account of higher crude oil and silver imports. Also, export growth was lower than import growth. Imports in 2018-19 grew by 10% over the 21% growth seen in the previous year, while export growth moderated to 8.6% from the 10.1% growth recorded a year ago. The slower export growth in 2018-19 was impacted by the global economic slowdown and trade tensions. The external market scenario, both for imports and exports, is unlikely to see changes in the near to medium term. Thus, we expect import growth to outpace export growth in 2019-20 also. Imports are likely to grow at 15% and exports are likely to grow at 8% this year. We expect the current account deficit to widen further in the current year. For the first 9 months of the fiscal year 2018-19, the current account deficit widened to 2.6% of GDP as against 1.8% in the corresponding period previous year. Current account deficit was pressured by higher trade deficit and rupee depreciation despite there being higher net invisible receipts. We believe that the pressure on the trade front could lead to widening of current account deficit in the current year. We expect current account deficit as a percentage of GDP to be at 3% of GDP in 2019-20. There could be a buildup in foreign exchange reserves in 2019-20. The foreign exchange reserves as of end 18-19 stood at around $412 billion, which was $12.5 billion lower than the previous year end. During 2018-19, the forex reserves witnessed a sustained decline from the start of the financial year till December 2018, chiefly owing to foreign outflows, higher imports, and higher dollar sales by RBI to stem the depreciation in the rupee. Since then, higher foreign inflows have aided increase in foreign exchange reserves. The long-term rupee dollar swap worth $5 billion undertaken by RBI in March 19 led to an increase in the forex reserves. We expect forex reserves by the end of 2019-20 to be in the range of $425 to $435 billion. The increase in reserves by the end of 2019-20 could be led by expectations of higher foreign investment inflows and additional rupee dollar swaps to be conducted by the RBI. Rupee could experience depreciation against the US dollar in the current year. During 2018-19, the value of the currency moved in the range of rupees 64.9 to 74.4 per dollar. It ended the year at 69.2 per dollar, a depreciation of 6% from the start of the year. The rupee depreciated in the first 8 to 9 months of the fiscal on the back of increased foreign fund outflows, rise in import bill following the surge in global crude oil prices, and the overseas strengthening of the US dollars. The RBI intervened by selling US dollars in the forex market, aggregating $15.4 billion during the year to limit the fall in the rupee. We expect a 3 to 3.5% depreciation in the current fiscal and the rupee to be in the range of 71.25 to 71.5 per dollar by the end of March 2020. We believe current account deficit as well as the external strength of the dollar would guide the domestic exchange rate. With the world economy still facing some uncertainties and the likelihood of the dollar strengthening, there would be a tendency for the rupee to be under pressure. Thank you.
Thank you, Sushant, Kavita. And dear participants, will be taking a break of 2 minutes before we begin a Q&A session. You are please requested to start keying in the questions in the slot provided. I repeat, we'll be having a break of 2 minutes before we begin a Q&A session. In case of any queries, you are please requested to key in the questions in the slot provided. Thank you.
Welcome back. We have received a few questions. One of the questions is, which sectors are expected to drive growth in the economy in 2019-20? Uh, we feel that the sectors such as construction and the cement, steel, e-commerce, and hotels to an extent would be the sectors which would propel economic growth during the year. We have another question. What could be the concerns of rising crude oil prices on the Indian economy? The rise in crude oil prices would lead to a widening of the trade deficit and consequently the current account deficit also, which would in turn lead to a depreciation in the rupee and that could prompt foreign investment outflows from the country. Rising crude oil prices also would pressure the fiscal deficit of the government, which is already under considerable strain. We have another question as to how India stands to benefit from the US-China trade war. Uh, the US-China trade war and the resultant restructuring of global supply chains holds opportunities for India. However, it need to be kept in mind that this could take time to materialize and these opportunities would take time to fructify. We have another question as to how do you foresee the liquidity in the banking system with bank credit growth outpacing deposit growth? The liquidity in the banking system is currently pressured by the high levels of currency in circulation and the lower government spending. In the coming days, we see an improvement in this with the currency coming back into the banking system and also with the government increasing its spending gradually. Both these factors were election driven, that is, the increase in currency in circulation and the lower government spending. Also, even though the deposit growth is likely to be lower than the credit offtake, the liquidity support from the government by way of OMO purchases and the currency swaps would help improve the liquidity in the banking system going forward. We have another question of what is the impact of a slowdown in consumption on the economy? Consumption greatly affects the domestic economic growth prospects because private consumption expenditure accounts for nearly 60% of the country's GDP. Lower consumption also means there would be lower tax income that mainly from goods and services tax collections, which in turn could pressure government finances. This could lead to higher government borrowings, which in turn could raise interest rates and further pressure economic activity. These are the questions which we have.
I think there are no more queries coming in. That was the last question taken up for the day. Thank you again to all the participants for taking your time out and being a part of this Care Ratings webinar. We hope the discussion was insightful and we look forward to your participation in future also. For any other queries, feedback or suggestion, you can please write to us in the comment box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.